Thank you, Miss Jessie, for this opportunity and more than a handout to educate you on how to buy a home and some of the details you need to know because one of the things about buying a home is that no one ever really knows they're ready because no one really understands what they need to do to buy a house. There's a lot of rumors, there's projections, there's assumptions that are done that can deter people from purchasing their home when they're actually ready. So there's a lot of myths. There's a lot of misinformation, and some of the things we're going to be doing today is debunking some of those myths and educating you on the process on how to purchase a home. Also, some tips on how you can prepare to buy a mortgage. And on the screen right now is some of my contact information. So if after you watch this, you'd like to reach out, you can either call my work cell, email me. You can scan the QR code that's on there and have access to a free home buyer guide as well. So let's get into it. So when you're buying a house, there are a couple things that we look at. Okay, we call these the four C's of lending. So there's credit, capital, capacity, and collateral. And we're going to go through each one and kind of describe which one is. But on the surface level, first thing and the most thing that people think about is credit. And most people, when they're thinking credit, they're like, well, I either don't have credit or I have bad credit. And the funny thing about bad credit is it's subjective. I have clients who they truly feel like their credit is done, and we go ahead and we pull it, and it's not as bad as they think. We also have people on the other end who are like, I have great credit, I don't know anything. But then unfortunately, um, they didn't realize that they actually don't have good credit. But the cool thing about credit is it's something we can fix. That's why when you're thinking about moving, okay, and you want to know if you can qualify for a mortgage, one of the things we're going to do is pull a credit report. And a lot of people get nervous about this because they don't want a credit. Everyone's been told, oh, a credit inquiry is going to kill your credit. And that may have been true 10, 20 years ago, especially if you're going car shopping and they run your credit, 30 different times, that can really lower your score. Got to remember your score on your credit report, that is actually very subjective. Okay. Um, Different things on your credit matter and hold different weight. And a lot of changes have been made over the years to make getting a mortgage and doing a credit inquiry less impactful on your credit. It's something that has to be done no matter what if you're buying a house. So you might as well bite the bullet, get that credit pulled, because then we can give an accurate pre-approval. Okay, so credit. What do we look at when we look at credit? Many people think it's just our credit score. We're only looking at the number. And that's not necessarily true. What we're looking at is the payment history. Okay, this is how long have you been paying on a debt? A debt could be a credit card, car payment, another mortgage. It could be anything that is self-reported. A lot of people now are self-reporting their utilities and things like that. We want to look at, okay, well, how long have you been doing this? And what has the payment history looked like? Do you pay on time? How many late payments are there? Um, what we want to see is we want to see consistency and we want to see a history. Now, a lot of people think, well, I don't have any credit history. That's okay. A lot of times we can supplement that with additional credit. For example, we can look at, okay, well, have you paid your utility bills on time for a certain amount of time? Do you pay rent? Rent doesn't get reported on your credit report, but we can get a rental history. We want to look at certain things to see, okay, how responsible is this person with paying on time and not missing payments? And along the longer the history is of that debt, of that payment history, the better your credit can increase. So Those credit cards that you pay down to zero and then you close actually do more harm than good. And that is why you see your credit score drop if you go ahead and pay off your credit cards and then close the account. Don't close the account. You can pay off your credit cards every now and again, maybe use it for a small purchase and then pay it off immediately. That's going to show a smart payment history, a long payment history that shows that you're responsible and you have that history of paying your debt on time. The next thing, which I kind of touched upon, is credit utilization. The credit utilization is how much do you need your credit? Do you have credit cards that are maxed out? What that indicates is that you didn't necessarily have the cash to buy things and you needed to max out your credit cards. The longer they stay maxed out, the lower your score is going to go. So you may pay on time every single month, which is great. Keep doing that. But you really want to look at paying down that principal because they're looking at how much do you use of the credit? Do you need it all the time? Do you need it constantly? Um, even if you're a person who pays off the balance every month in full, at any point, it's going to look like you use it all the time. It's going to look like you use it to the max, even if you pay it off every month. Okay. So the rule of thumb is to only be using 30% of the limit. So if you have $1,000 limit, you're looking at keeping your balance below $330 a month. Okay. Keep what you use of the credit low. That again, that's showing you don't need the credit even though you have it. If you get a credit increase in your limit, great. Don't use it. Don't use it. If you don't have to use it, don't use that because that's going to show a lower utilization and you didn't even have to pay down principal. So that's some tip to keep your utilization down. Now, account management. Okay, this is how many delinquencies, this is how many, if you have any collections or judgments or anything showing on your credit of bad credit history, right? A bad payment history. So after a while, if you don't pay your bills, they're going to put you in a collection. Okay. It may even go from a collection to a charge off. They're looking at those things. They're looking at, did you pay the collection off? Okay. So just because you have a collection and you paid it off, that history still shows on your credit report for many years. Now you can negotiate to have it removed like it never happened when you do pay a collection or a charge off. But they're not obligated to remove it off the credit report as if it never happened. That can stay on your history and it can bring your score down. So you want to try very hard to monitor your credit as much as possible. There's so many free apps out there that can monitor what's going on in your credit. Try to avoid buying anything that they're offering. You don't really need any of the services that they offer. What you should be using those free sites for is to see, okay, what's on my credit? Are all the accounts accurate? Are the payments accurate? Are the balances accurate? So you're looking for accuracy when you're using those apps. The rate or the credit score that they give you on those free apps, it's 99% of the time it's not accurate. It's based off of a model that's used for informational purposes only, which they don't hold things as these payment history and credit utilization and account management isn't going to have as much of an impact on that score. Okay, so it's a more liberal score, if you will. Whereas if when you're going to, get a credit card or pull your credit for a mortgage, that's going to be slightly more, it could more than likely is going to be a little bit lower than those other scores because they're looking at things heavier, right? They're looking at that payment history that's going to hold more weight. The utilization's going to hold more weight on that score. Here's the good news, right? All those things I just mentioned, they're things you can fix. Now you might need time to fix them, and that's perfectly okay. All right, at least you know. So when we go to pre-approve, if we need to work on the credit, we're going to give you some suggestions and homework to go back and do to fix that credit to help you get pre-approved. Okay. The other things you can look at is you might qualify for a mortgage with your current credit history, credit utilization, credit score. However, also ask if there's any benefits in increasing the score when you go to get pre-qualified because it's more like a tiered system. So you might have a really great credit score, but if you just do a couple small adjustments, your score might skyrocket into a whole other tier where you're getting a better interest rate or the file itself becomes easier to close. Those are some things you want to make sure you ask when you are getting a mortgage. Um, the second C, capital. So the capital, this is your assets. This is how much money you have saved. Now, although there's plenty of home buying programs and services out there to help you, you want to have something. You want to have a little bit of something. Okay. So what is capital? Capital are your assets. It's your down payment money, and it could be our reserves. That's what we're looking at. So what is considered an asset? An asset is money you have saved up in a bank account, savings account, could be a retirement account, could be a 401k, could be stocks that you purchased, it could be, believe it or not, it could be a car, it could be a boat, it could be jewelry you have that you're going to sell to use to put that money towards the down payment, or into buying a house. That's an asset. If you're applying for any grants or any first-time home buying down payment assistance programs, that's an asset. Okay. Now in Philadelphia, there are many different um, first-time home buying programs and grants out there to help people with this part. Okay. There's also other programs if you don't qualify for the state or the local programs that can also assist with down payment assistance. Now, when you're dealing with down payment assistance, you're also looking for a give and take. Okay. So remember, they're giving you money. You're going to be sacrificing something in return for that money. And most of the time, it's your buying power. So these programs, although they can help you with your down payment and closing cost, your loan amount is going to be the approved loan amount could be a lot lower than if you didn't use those programs and you found the money another way through a gift. That's where a family member will give you money that they sign a letter saying that you don't have to repay. Um, a seller concession. A seller concession is when they give up some of their proceeds, their profit, from the purchase of the home, from the sale of the home to pay your closing costs, which we'll go into. Um, it could be, another way to get money would be credits. Different loan programs have 0% down. Any veterans out there, just so you know, if you are a veteran, you could qualify for a VA loan, which has a 0% down payment. So make sure you look into those programs too, because and compare them. Because again, just because it sounds good and it sounds like great, I could buy this house with no money, you might be limiting yourself. Okay. So make sure you understand all the details, but there are some really wonderful programs. Some other things you want to take note on is you can reach out to um, different nonprofits have the ability to offer smaller grants. Now it's not going to be a ton of money, but if you can get like 1,000, 2,500, that can make or break the decision on whether or not you can afford a home or not. So assets are a really big thing. Um, and again, when you are saving money, you want to save it in an actual savings account. It does not have to be at the same account that your checking account is in. You can use two different banks. Just know we're going to look at a 2-month history. And if we see things like large deposits, um, especially if it's a large deposit of cash, we're going to question where that money came from. That's called a verification of deposit. If you are transferring money through the electronic transfer systems like Zelle, PayPal, Venmo, Cash App, we'll see those. Keep in mind, we're going to question certain transactions. And if we see that you're paying a Zelle or a Cash App to the same person and it's the same amount every single month, or there's a pattern of payment, keep in mind we may question, hey, is this something like, do you owe this person money? So we are looking at the transactions on a bank statement to see, okay, what's happening here? Where's this money coming from? And the reason we have to do that is to prevent money laundering. Money laundering played a big impact in 2001. And so part of that to catch that is, we look at assets, we look at where the money's coming from a lot harder than any other loan you can get because we need to make sure that, we're following the right um, legal guidelines for verifying those funds. So what is your down payment? Okay, the down payment is very simple. It is whatever the sale price of the house is minus the loan amount. So if I say you are pre-approved for a loan amount of $150,000, and let's say you have $20,000 to put down, I know, let's just say hypothetically you have $20,000 to put down on a home, your approval amount would be 170. Okay, because that would be the sale price minus the 20 brings you to that loan amount of 150. The down payments range between anywhere between 3% of the sale price all the way up. Okay, that's going to depend on one of those legs that we talked about, one of the four C's, and how strong they are. So if you have strong credit, you can get away with putting the minimum down payment. If you have a lot of assets, again, you might be able to put down, a larger down payment. So there's a lot, or you may not be required to put down such a large payment, is what I meant. Sorry, because that goes into something called a reserve. Okay, so what are reserves? This this is money left over after the whole transaction is complete. Now, I mentioned those grant programs earlier, right? The state grant, the city grants, even some of your down payment assistance loan programs themselves, they do require you to have some sort of reserve, which means that after the purchase, how much money is left over? Typically, you're looking at between 1 to 3 months worth of payments left over in your accounts. Again, your accounts can be checking, savings, a CD, an IRA, a retirement account. It's not money we're going to make you put aside. We just want to know that you have something in case of emergency to make that mortgage payment. So keep in mind, if you are tight on assets, um, we are going to want to verify that, you have something left over to, after you purchase that home. So that's capital. That's the money you need to purchase the house. This is probably the biggest roadblock when people think about, I want to buy a house, but I can't. When they say they can't, this one really hits hard because they think they don't have enough money. But that's not your job to find out. You don't know how much money you're going to need until you get pre-approved, and you might be surprised. You might need less than you think, and in a lot of cases, that's what happens. And you might qualify for a lot more grants and programs than you realize. So it's really important before you write yourself off to talk to an actual mortgage pro, a lender like me, who will go through all your options first and let you know exactly how much you need and how you can get there, right? You don't necessarily need it right now, but if you don't know how much you do need to save, how is it possible you're going to save it? So again, always talk to them. It's okay if you need some time to save it. It's okay if we need some time to um, figure out how you qualify for a program to get the down payment. It's okay. We don't go anywhere. Okay. The important thing to know is we're building your roadmap to home ownership. So, what is the third C? This is capacity. Capacity simply means like, can you afford that? Can you afford the mortgage, right? How much money do you make? So, what we're going to be looking at when we're looking at the capacity part, how much money you make, is we're going to look at your W-2 earnings. We're going to look at if you're a small business owner, we're going to look at your tax returns to see how much you claim. We're going to look at, if you're Social Security or if you're on Social Security or you have a pension, we're going to get the proof of see, okay, well, how much do you make? How much do you get in your Social Security? How much do you get in your pension? If you get VA benefits, what are the VA benefits? So we're going to include all of the income that comes in, and this is all reportable income, so it's documented. Unfortunately, if you get paid under the table, and you don't claim it on the taxes, we can't use it. So keep that in mind that if you are working as a contractor, okay, and an independent contractor can be, you're a delivery driver, you're an Uber driver, you run errands and you get paid cash. That's fine. You can absolutely do that. But we are going to want to see 2 years of tax returns to show that you claim all the income. Okay. Now, couple terms, salary versus hourly. Um, some people get paid a salary, which is they get paid the exact same amount every single paycheck, no matter how many hours they work. Hourly is where your paycheck could vary week to week depending on the hours. You might get 40 hours one week, 35 the next, 42 the next. What we do in those situations is we're going to average out that hourly pay. Now, it's really important that you keep some good records, or you know at least how to get your records. And what I mean by records are, you got to know how you get your pay stubs, you got to know how to get your W-2s. Typically, you'll have a payroll company, or you'll have someone in your human resource department who can help you out with that. Or if you know who gives you the paychecks, like what company processes them. If you know the login, you can log right in and you can get all that information. You get your pay stubs, you can get your W-2s, and you have access to them even if you left the company. The other thing you can always do is get a verification of employment. That is something your lender can also help you out with. When we average hours, for example, let's say you get overtime. This happens a lot with my nurses or my home health aides. You work a lot of overtime. We do have to average that out. And so what we're going to ask for in order to see that is the last pay stub of each of the last 2 years. Why do we ask for that? And your W-2. Wouldn't it be on your W-2? Great question, and that's what I get asked a lot. Your W-2 combines all the income in one. If we have your final paycheck for the year, that's gonna break down what your normal regular hours were, what your overtime, any bonuses, which allows us to find a proper average. And you don't want to short yourself by not providing that information, because if you earn it, let's use it. And that can really be the difference between qualifying for a loan and not qualifying for a loan. Okay, so averaging hours and overtime rules are pretty much the same. Social Security income. If your Social Security income is non-taxable, right? Which it's easy to see whether it's taxable or not because it'll be on your taxes. If it's taxable, if it's non-taxable, we can actually gross that up a certain percentage, meaning that let's say you get $1,000 a month in Social Security, we can gross that up on most loans as low as 15%, sometimes as high as 25%. So we can qualify you based on 1,150 or sometimes 1,250, right? So we'll do that when we do the pre-approval, but it's really good to let us know if your Social Security income is taxable or non-taxable, because if we can give you an extra bump and that bump gets you qualified for the house you want, we want to be able to use it. But that's also why sometimes you will see your Social Security number on an application increase once we review it, because we find out, oh, wait, we can give you credit for more money. And the reason why they do that is because it's a general rule of thumb that you'll get a cost of living increase every year or so when you're on Social Security. I've had clients qualify for mortgages just based on Social Security, pension. So don't think that you can't buy a house because you don't have a job. Lots of people buy houses and they don't have a job. Okay, they get Social Security, we lose that, and we see what we can do. Or they're retired, and we can also, with retirement, we can also use your retirement income or your retirement savings as potential income. So there's a lot of ways we can use capacity to get you qualified for a mortgage, but we just need to know your entire story. We need to know all the details. The more details we have, the more we can see if we can use or not, okay, and get you qualified for that mortgage. So the other thing we look at with capacity is going to be your history. How long have you worked? So if you do work for a job, there's this rumor that you have to be there for 2 years. You really don't. We just need to verify that you've had a job for 2 years doing something similar. So let's say you have been at your current position for a year. And before that, you didn't have work. You had a gap. Maybe you stayed home to watch the kids. Maybe something happened. Maybe you were laid off and it took you a while to find a new job. Whatever the reason, we're going to look at that as a gap. And when there's a gap, we just want to make sure you've been at your current job for 6 months or longer. And then what we're going to do is we're going to say, okay, well, before the gap, where did you work and how long? And we're going to go back 2 years from that gap period to see a 2-year work history. So again, a lot of people write themselves off thinking, oh, I won't be able to get a mortgage because I haven't been at my current company for 2 years. Not necessarily true. You just need 6 months after a gap. If there was no gap, and a gap is defined by 3 months or longer, if there was no gap in employment, it's okay. You could be at your current job for a month. If you have the details, if and it especially helps if your salary in those transitions. But if you have proof of how much you're going to be paid, the hours are guaranteed, we can use that income without you having to wait. So again, don't make the determination before you talk to a loan specialist about whether or not you qualify based on how much money you make per month. Okay, now finally, our last leg of the table, and I do like to look at these four C's as a table, right? And a table has 4 legs, or a chair will have 4 legs. Now, you can use that chair or that table even if one of the legs is loose or broken or sometimes even missing, because it depends on the strength of the other 3 legs. So you may have your credit might not be as high as you'd like it, okay, or as good as you'd like it. But let's say you have some money saved and you've been at your job for a while and you're not purchasing above your means, meaning that the amount of the mortgage payment is going to be a small percentage of what you make per month. Typically, let's say it's 30% of what you of your gross income, okay, before taxed income. That's going to be a nice strong file. So even if you don't have a lot of money saved up, it still might work because you have a good work history or you have, decent credit. Vice versa, let's say you have good credit. Let's say we're working on Social Security income and you don't have that much money saved up, but you don't want a large house either. Then if the collateral we have, if you're able to put down more money or you're not, again, going above your means and you're well below your ratios for your debt to income, just how much debt you have versus how much you make, then again, it might be strong enough to hold a mortgage. You are not the one who can determine that. Again, that's what we do. That's what our role is in the situation, is to determine how much money, how much of a home or collateral you can qualify up to. Okay, so again, what is a collateral review? What we're looking at the value of the property. We're looking at the taxes and your homeowners association, and if there's any homeowners association dues. Condos typically have homeowner association dues. These are all part of that housing payment. And the loan amount, how much are you putting down compared to the sale price? Now, property value, the way we calculate that is we get something called an appraisal done. We do that after you go under contract. It is the only lender fee or mortgage fee that you pay up front, because this is a document that's your document. Okay. So we order the appraisal. The appraiser goes out to the house. They give an opinion of value based on what they noticed, the pictures they took, and also homes in the area that are very similar. So they're going to create this opinion of value, and that is the term that determines the property value. So what if the house appraises for more than what you're buying for? Not a problem. Okay, we actually like that. Now, we don't go ahead and tell the seller that. We just tell the seller all is good to go. But what that means is you're buying a house for less than what it's worth and you have instant equity. Okay, equity is the difference between the property value and the loan amount. That's always a good thing. Okay, but when we qualify you for a mortgage, we're using the lower number between either the sale price or the appraisal. And unfortunately, sometimes the appraisals can come in below what you're buying the sale price of the house for. And in those cases, we can do a couple different things. We can look at contesting the appraisal, seeing if there's any errors made or misinformation on there. You can renegotiate with the seller to see if they're willing to take less money. Or if you can't renegotiate, or you guys can both, the seller and you can decide to just walk away. Um, in certain occasions that I'm capable of doing, typically what I like to do first, if there's no errors found on the report, I may request another appraisal through a different lender that I work with to see if we get a different value. So there are ways that we can work through that. So those are how we qualify or approve people for a mortgage. Okay, so now what's next, right? How do we put it all together? So the first thing you have to do when you're thinking about moving is I would actually talk to a mortgage rep. I usually do a 15-minute free consultation where we talk about, your goals and what you're looking to do, and then I would have you fill out the loan application. And that's where I look at all four C's. I look at where the strength is, and then give you the pre-approval. Okay. Now, pre-approval, very different than a pre-qualification. So pre-qualification is when a lender will take the application that you give them. They may not run your credit. Maybe they don't ask for any backup documentation to prove what you said. They just look at what you told them and they say, okay, well, based on this, you could potentially purchase up to this amount. Be very careful if you're getting just a pre-qualification. That doesn't mean you're guaranteed the mortgage. Okay. The pre-approval is a step up from the pre-qualification. The pre-approval is where I take all your information, but then I'm also getting the details. I equate it to like back in school when we had to write papers and we had to source where we got the information from. Like we couldn't just make it up. So we had to write down like, I'm old, what encyclopedia I used, right? Or what other resource did I use, and mark the pages and do all that to say, okay, here it is. That's what your documentation is. And I'm sure you probably heard horror stories from people about, oh, I just send my documents in all the time. They kept asking me for this, that, or the other thing. Got to keep in mind that sometimes you may think you're uploading the right thing. It's really not. And we may need to go back and forth to get the right information on that document. But as long as you send in the appropriate information, as long as we're sending in, your W-2s, your pay stubs, tax returns if we need it, Social Security award letters, your bank statements, so we can look at two months worth of history, we can then prepare you and give you that pre-approval. And that pre-approval means we ran your credit, we looked at and verified all the information you told us, and we even ran you through an automated underwriting system. Sometimes I'll even go one step further and have an actual underwriter. These are the people who approve loans. Look at the file to make sure I didn't miss anything. This is what you want to use to go shopping, because then what I could do if I pre-approve a client and you put in an offer on a home, I can call that listing agent and tell them all the great things you've already done. I can talk you up. And that could be the difference between them picking you and picking another offer that may be even higher. So always go with the pre-approval. Yes, sending in paperwork stinks. No one likes that. It gets very frustrating, but at least you know you have a higher possibility of getting the mortgage. Anything can happen. I don't want to, say it's guaranteed, but I'd rather go into something being very confident than being a little bit unconfident or unsure. So make sure that if you're not using me, if you're using someone else, you're getting an actual pre-approval to buy that, to put in your offer. So starting your journey, that's the key. Okay. I can guide your path to homeownership. Um, it all starts with a conversation. Then, like I said, we're going to look at those four C's, and we're going to say, okay, this is what you need to get pre-approved, or you are pre-approved. Here's what we need. You'll have that roadmap, and it could be a small road, might be a long road, but regardless, you'll have that information. You'll have that knowledge. And in my opinion, Knowledge is the real down payment. I'm Paula Hune. I work with Funding American Mortgage. I'm a senior loan officer. There's my contact information on the screen again. Feel free to scan the QR code, download my free home buyer's guide as well, and we can talk more about what program is going to work best for you. Thank you.